Well, good morning. I'm Jaginder Rana. The topic of the day is Indian insurance sector needs a revamp. Indian insurance sector needs a revamp. The Union Minister for Road Transport and Highways raised a hornet's nest by urging the Finance Minister to reconsider the 18% GST rate on health and life insurance. Now, the upcoming GST Council meeting scheduled for next month is expected to discuss various options including reducing GST to nil for senior citizens and term insurance, as well as lowering the rates for individual health insurance policies with a sum insured of up to rupees 5 lakh. Currently, 74% of GST revenues from insurance are allocated to states, generating rupees 24,000 crore over the past 3 years. Optimistic GST for senior citizens health insurance will contribute to welfare. But there are other critical issues within the insurance sector that could impact the government's fiscal health and should be addressed. So in financial year 23-24, health insurance contributed to rupees 1,09,006 crore by 37.62%. Of rupees 2,89,699 crore in non-life premiums, with group health insurance accounting for rupees 55,020 crore. Our group health insurance, excluding government businesses, has seen loss ratio exceeding 100% from 2013 to 14 to 2020 to 23. So for the three public sector insurers facing financial stress, the loss in this segment amounted to rupees 12,780 crore, with a conservative net expense ratio of 25%, pushing the loss to rupees 15,897 crore. This is nearly 92% of the capital of rupees 17,250 crore injected by the government since financial year 2020 to maintain solvency. Essentially, taxpayers are indirectly funding corporate group health expenses. Large insurance portfolios with high loss ratios over extended periods, coupled with operational inefficiencies, contribute to capital erosion. ICRA estimates that an additional rupees 10,000 crore capital infusion is required for these three public sector insurers. So the Ministry of Road Transport monitors the pricing of compulsory third-party motor premiums, which contributed to rupees 54,455 crore, 60% of rupees 91,780 crore motor premium in financial year 23-24. So the mix of motor premium has shifted significantly over the past 2 decades from an 80-20 ratio of own damage to third party in 2002-3 to 40-60% in 2023-24. Higher than stipulated commissions acquisition cost even for this regulated TP premiums involving motor insurance service providers and intermediaries have over the years reduced the premiums available for insurers, thus diminishing investable funds. So several audits by IRDAI have highlighted excess payments above regulated rates classified as management expenses for advertising, risk consultancy, travel, call centers, or infrastructure. So, for example, a major insurer paid rupees 30.73 crore for logo share and rupees 25.09 crore for infrastructure expenses in 2012-13, yet faced minimal penalties of rupees 5 lakh each in 2016. So while the penalty limit has since been raised to rupees 1 crore, they do not act as a deterrent, as management expenses are now limited to 30% by IRDAI, effective from April 2024. Strict monitoring is essential to ensure effectiveness. Many non-life insurers have a combined operating ratio above 100%. So to improve profitability, insurers need to focus on repricing portfolios, enhancing claims management, and investing in technological and operational efficiencies. Currently, only about 60% of the premiums paid by customers is available for pure risk cover due to intermediation costs, management expenses, and GST. So, risk-based solvency is therefore crucial for aligning insurers' strategies and achieving long-term profitability. To improve industry transparency, the Insurance Information Bureau or General Insurance Council should publish premium and claim data for the top 10 group health, property, and casualty accounts over the past decade. So, additionally, insurers should disclose their gross management expenses on a quarterly basis, similar to mutual funds. The financial statements of insurance intermediaries for the past 5 years should also be made public, so with correlations drawn to non-fee income in the case of banks and NBFCs. The comprehensive insurer-intermediary relationship matrix would help highlight any emerging concentration of power in the insurance sector. Furthermore, the company-wise and portfolio-wise GST collections should be reported. So the Indian insurance market is projected to grow at 7.1% in real terms from 2024 to 2028, outpacing the global growth rate of 2.4%. So the efficient management of the substantial insurance revenues, over rupees 12 lakh crore in non-life and life premium for financial year 23-24, could help boost GST collections, corporate taxes, and insurers' investable funds. Thus, in turn, would enable the government to support the social sector. While adjustments to GST rates on health insurance are important, a more efficient metric of success would be how much the insurance sector can contribute to reducing the fiscal deficit. A comprehensive view of the sector's operational and regulatory investment interventions is needed to optimize its potential for both economic growth and social welfare. The Insurance Regulatory and Development Authority recently spoke of how India needs more global players to grow the insurance sector. It is the time to allow them to set up shop on their own without a local partner. A 100% foreign direct investment policy could bring in more foreign insurers. The regulator is reading the writing on the wall. Many foreign players are unhappy that their local partners are not allowing them to raise their stakes in joint ventures and give them more say in running the businesses. Although the government liberalized the rules in 2021, there are just a few joint ventures where the overseas insurer has a 74% stake. In 2022, Aviva upped its stake to 74% in Aviva Life Insurance, while Generali's stake in Future Generali Life Insurance went up to 74%. Swiss insurance giant Zurich now holds 70% in Kotak General Insurance. Some players like AXA have existed in India. Abdern or Standard Life Abdern existed HDFC Standard Life Insurance in June 2023 after a 22-year-long partnership. So the last foreign players to enter the life insurance space was Japan's Tokyo Marine, which floated Edelweiss Tokyo Life. Some like Germany's Allianz are divorcing their local partners but could end up marrying someone else. As Kamlesh Rao, MD and CEO Aditya Birla Sun Life Insurance puts it, foreign players want the comfort of being in control and the satisfaction of being able to run it themselves without having to partner a local entity. Psychologically, it makes a difference. If they own 100%, they can always hire local professions to run the operations. However, the truth, as Ludh Marathe, MD and partner at Boston Consulting Group points out, is that most large insurance companies are backed by financial institutions or conglomerates which are generally unwilling to give up control, especially since the businesses are doing well and there is potential to grow. And they are not apologetic about it. The Vibha Padekar, MD and CEO HDFC Life Insurance, has discounted the need for a foreign equity partner, saying homegrown companies understand the needs of Indian customers better than their foreign counterparts. There is no need for a foreign partner. I think that ship has sailed where we need any intellectual horsepower from elsewhere. So the confidence comes from their ability to raise capital. As another insurance sector CEO considered to FE, considered that the promoters would prefer to list on the exchanges to raise capital rather than sell a stake sale to foreign partners. It would allow us to remain majority ownership and management control on a fast-growing market. A McKinsey analysis says Indian life insurance command valuation multiples of 7 to 10 times price to book compared with just 1 to 2 times for their regional peers in Asia. So the reasons for this include their strong performance over the years. India's insurance sector recorded a gross written premium exceeding $130 billion with an 11% CAGR during FY 2023, outpacing Asian peers like Thailand and China, which grew at less than 5%. So as Birla Sun Life's Rao points out, there are now options to capitalize the business by raising subordinated debt depending on its size and net worth. Companies use a combination of equity and debt to ensure their growth ambitions are met. The last 5 to 6 years have shown that domestic firms have the capital to inject it whenever needed. About a month back, it became clear that Germany's Allianz Group intended to exit its 26% stake in both Bajaj Allianz Life Insurance and Bajaj Allianz General Insurance, ending a partnership of over 2 decades. So industry insiders attribute the split to Bajaj Finserv's reluctance to allow Allianz to raise its stake in the ventures. To be sure, the global insurers are aware of how difficult it can be to build business on their own. Foreign partners do recognize that much of the value in partnership comes from the Indian partners' brand and distribution capabilities. Even if they want to increase their stake, it could come with a steep valuation. McKinsey has pointed out, while achieving a CAGR growth of over 17% in new business premiums, India's top 5 private life insurers have seen a rapid net profit growth of less than 2% CAGR over the past 5 years. So this is thanks to challenges in the cost management and operational efficiency due to escalating expenses, including increased commissions, operational cost, employee-related expenditure, and marketing expenses. The foreign players are still keen on investing in India at the 74% level with a 26% local partner, but need a compelling trigger. They are looking for a spike in the penetration level or the possibility of handsome exits. There is no doubt India is the ideal market for insurers over the next 10 to 15 years, given favorable demographics and low insurance penetration. Nonetheless, Kasparus, the MD and CEO of Shriram Life Insurance, believes that for more foreign players to come in, a strong catalyst such as a sharp rise in partnership or sharp rise in penetration is required. So the challenge is that with the GDP growing 7 to 8% annually, the economy expands so quickly that to make a noticeable impact on penetration, the insurance sector has to grow at an even faster rate. Thank you. Thank you very much.